Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to do what we call a newbie review of velocity banking. So there are some of you out there who have watched these velocity banking videos, get the concept, maybe just want a step-by-step practice from the very beginning of what to do, which I will do for you in this video. Now, just to kind of give you a little background about myself, I've applied velocity banking in several different facets. So first one is that I was able to pay off 25% of the mortgage in a year. So this is my mortgage statement. You can see here that the maturity date of the mortgage is 2051. That means that's the very last payment of the mortgage. And if you want to subtract 30 years, that's when I got the mortgage. So 2051 minus 30 is 2021. So 1 year had passed by then, by the time the statement had come out. If you just do a quick calculation, 238,496 minus 179,681.65, $58,000 was paid off in 1 year. And if you want to see the percentage, you divide by the original loan amount, 238,496. That's 25% if you just round this up, right? So I was able to pay off 25% of the mortgage in a year using the velocity banking strategy. Now, another situation where I've been able to use it is with multiple lines of credit. So I keep track of my data, my numbers. So these are all the balance statements of my lines of credit from this year, 2023, with the interest payments and the minimum payments amounts. And so what I did is I just kind of did a sum of all the interest payments and also show you how much I paid off in 2023 in credit lines. And so I paid off $51,000. I had $112,000 in debt in line of credit or credit card debt this year, and then I paid off $51,000 by the September by this month, which is the month of September. So just kind of give you a little bit of my credentials here. Okay, so now let's just kind of go to how we would do velocity banking. So there's really only two steps to it, right? It's really simple. This is a newbie review. If you know the strategy and you just need a little bit of practice to get started, all you have to do is two things. First one is the budget, right? So the budget tells us what's happening with our money, and when we list up all our paycheck and expenses, especially with our expenses, we kind of know what we can do to recover our cash flow, right? Because that's the whole name of the game, is to recover our cash flow to pay off our debt. Okay. Second thing is that we need to select our operating account, and the operating account is going to be a line of credit. So if you don't know what a line of credit is, all it is a financial tool where you can borrow money, pay it back, and reuse it over and over again. So if you have a credit card, that's exactly what a line of credit is. But there's other types of lines of credit, like personal lines of credit, business lines of credit, HELOCs, home equity lines of credit. They're a little bit different. The line of credit tools, there's some nuances how they work, but just be aware that we're going to use a line of credit to use as an operating account instead of a checking account, which is what the average American uses. So here I have what we call LibreOffice. So if you have Excel, Google Sheets, you can use that as well. I just realized that this was a free version, kind of like a free version of Microsoft Office or Microsoft Excel. And I like using desktop programs more than web programs, so we're going to use this for example. But let's just kind of go create our own spreadsheet to kind of demonstrate how we can visualize how velocity banking works. So first one is we have our paycheck, right? And then, so we're doing our budget, and then we have to write our paycheck, expenses, savings, whatever we have in our savings checking, okay? And we're gonna call this scenario the average American's budget. And then we're gonna have another scenario called the velocity banking budget, the velocity banking American, okay? So now let's just kind of assume that this is a $5,000 paycheck. Expenses are $3,000 and savings are $2,000. So that's actually not bad for the average American, because if you look at statistics recently, the average American cannot afford a $400 emergency. Like if they had something wrong with their card, they would be screwed, right? I don't know if you ever heard that statistic. Federal Reserve did study on that, I think like 2014. And so this has been going on for a while. And then with things like inflation, people are really feeling the pinch, okay? But let me just kind of go here. Let's color code this. So what we're gonna do is paycheck green. Yes, we love green. Green means money. Money is good. Expenses red. We don't want that. And savings, we'll call it a neutral blue. So savings is just like, yeah, money we have left over that we plan not to touch, or we're not supposed to touch, right? And maybe we're just saving it for a rainy day, or maybe for a down payment or something. But again, if you have $2,000 of savings a month, you're doing really well compared to the average American who's paycheck to paycheck. Okay, so now after you have your your budget, now you have your expense breakdown, right? So let's go ahead and do that. So expense breakdown, we'll go here. I'm going to go and color this red, highlight this. And what's really important is that this expense breakdown should equal this, right? So every single debt that you have is going to be its own line item. So for example, let's say you have a student loan, car loan, other things that are expenses, rent, and then we'll say other, food, gas, insurance, etc. Okay, so make sure that you do that. Now, what else is really important is that you have to always list all your debts, whether it's credit cards, loans, lines of credit. You always have to list every single debt as its own line item, because once we pay off the debt, that's essentially cash flow that's freed up. Okay, so I always like to use the same numbers. So we'll just say 10K balance, $400 monthly payment. And the interest rate, I'll say 6, but honestly, it's a little bit irrelevant. It's kind of going to make a difference, but not really. Okay, so 6%. And then we'll do the same thing with the car loan, right? So the car loan is what's the balance? 30K, 13K that I like to use, 13K balance. The average payment is $600 a month, and we'll say 6% interest. Okay. All right. So now rent, we'll do 1,000, and then other food, insurance, gas, we'll do 1,000 as well. Okay. So now what we do is just kind of sum these up. So it's 400, 600, 1,000, 1,000, and yeah, if we sum it up, that should equal 3,000. Let's make these all red. Okay, so now this is $3,000 and $2,000 in savings. Okay, so that's pretty much step one. We have our budget. Now, what is step two? So let's kind of go back here. The step two is we have to select our operating account, which is a line of credit. So let's say you went to the bank and say, hey, I want to get a line of credit. And they'll say, cool, how much do you want? And you could say maybe like, oh, 25,000. I'm like, all right, cool. So let's get a line of credit. So it's going to be split into things. So think about that you're getting all the information, relevant information of credit cards. So first you want to know the interest rate, right? You want to know the balance, so the credit limit, right? And then you want to know the current balance. So when you first get it, obviously the current balance is going to be 0, right? But let's just kind of work with this here. So let's assume that they gave you $25,000 in the credit limit here. Let's see, yeah, let's see, 25,000. So 25,000. Let me go ahead and darken that. Okay, so let's say they give you $25,000 in a personal line of credit. So they say, hey, you can go ahead and click the bank's website, go to the bank's website and click a button, and you can borrow up to $25,000, and you'll see it in your bank account the moment you click a button, right? It'll be in cash, right? So it's like borrowing. That's why lines of credits are great, because you're just borrowing cash and it's going directly into your bank account. Another cool thing is about lines of credit is that, let's say you borrow some money from a line of credit. Let's say you borrow $100, and then they on the next month they have a minimum required payment of $25. You can just borrow that money from the line of credit again and then pay it back, right? And then that satisfies the monthly payment. I call it robbing Peter to pay Peter. Like balance transfers are like robbing Peter to pay Paul, but paying your own line of credit with the line of credit is robbing Peter to pay Peter, Okay, cool. So let's just say we have a 15% interest rate. So lines of credit usually have a lower interest rate, or personal lines of credit usually have a lower interest rate than credit cards. Okay. And right now, because it's completely new, the balance is going to be 0, right? And then now what we have to do is do the velocity banking version of this budget, right? So let's just kind of see how that would figure in. Okay, so first of all, let's just do, let me copy and paste it, make this easier. All right, okay. So first of all, the paycheck will be the same, okay? So the way that people promote this strategy is like, oh, you can pay off your debt so much easier without changing your lifestyle or just tweaking your few behaviors, and you don't have to make more money, which is true, right? Like we're not changing, we're not making more money, okay? So what we're going to do is figure out how to free up some cash flow while using the line of credit as our main operating account. So the difference between the average American and the velocity banking American is that the main operating account for the average American is the checking account. Whereas for the velocity banking American, it's the line of credit. So what we're going to do is just kind of take a look at this and say, okay, how can I free up some cash flow? Well, I got a $10,000 balance here, $13,000 balance here, and I have a $25,000 line of credit. So why don't I just transfer this debt to here? 23,000, right? 23,000. Let me copy the formatting. So 23,000. Okay, 23,000, right? So what happens when we transfer this debt from here to here? Well, this goes to zero, this goes to zero, right? The rent, food, gas, insurance stays the same. And now our expenses have kind of magically gone down to $2,000, right? What used to be a $3,000 expense is now gone to $2,000. And now with the velocity banking strategy, based on what we're going to do, this is going to go to zero. Okay, we're not going to have any savings because the strategy is that you move this paycheck to that line of credit, which will satisfy the minimum monthly payment, and then accordingly take out your expenses when they're needed. Okay, so now what we do is if we do 23,000 minus 5,000, that's 18,000. And then eventually the expenses are going to go up 2,000, so that'll be 20,000, right? So what's going to happen is that our cash flow, which is 3,000, 5,000 minus 2,000 is 3,000. Every subsequent month, the balance is going to go down about 3,000, okay? So what we do is we create a formula, which is H2 minus 3,000, right? Okay. And then what we're going to do is see how many months that it takes. And let's put a column for interest paid. Okay, so let's see how many months it takes to pay off this balance of the line of credit. Now, here's the thing. There's going to be some inaccuracies here, but it's so that you have a better way or easier way to understand how the strategy works. So the way that interest is calculated is actually by the average daily balance. But if you're running a simulation, how are you going to know when expenses occur? You can't. So what we're going to do is just make it easy on ourselves and say, hey, the interest that we're going to pay while using this line of credit is just going to be based on the previous month's balance. But think about that. That's not that's not realistic, right? Because the moment that you put your line of credit into here, that's going to be the lowest average daily balance they'll ever have, right? And so it's going to be a little bit less than what we're calculating. But to make it easy, let's just do this. Equals no, I'm sorry, 15%, 15% times the previous month's balance, which is H2, and then you divide by 12. Okay, so why do we divide by 12? The reason why we divide by 12 is because interest rates are quoted annually and you're getting the monthly interest. But here's the other thing too, that's technically wrong because you're getting the average daily, the way it's calculated is by the average daily balance, right? So you got to do some multiplication with like multiplying by 365 or divide by 365 and then multiplying by the number of days and the average daily balance. But again, we're not getting that complicated. We're just making it simple. And here's the other thing too. I already know that the interest isn't calculated separately. It's added on to the next balance. But again, it's going to be mostly the same. But this is so that you have an easy, quick way of kind of estimating the interest. So don't get so accurate that it impedes your understanding. Because what happens with a lot, and people have told me this, is that people look at like all the numbers on a blackboard and they're really impressed, and then at the same time they're confused, right? So you don't need to be confused. You could do it yourself here. So we're paying about $1,250 in interest. Okay. So if you want to just go ahead and add that to the end, you can do that and you'll say, oh, it takes another month. Okay. But this is how we would pay off $23,000 of debt with a $5,000 salary, right? And $3,000 interest. So now most people, they're like really amazed. Oh my gosh, like $10,000, I paid that off in 10 months. Well, here you paid $23,000 in about 8 months. Okay. So think about that. And it was easy. You know, we weren't sweating to pay this off. We weren't doing beans and rice. All we did is just move some debt to the line of credit, put our entire paycheck to it until it goes down to zero, and then we're good. So now, you know, once we paid off the debt, we don't have to use the line of credit anymore because our savings are going to go up like 3,000 every single month, right? So it's going to be, you know, after we pay this off, then it's going to be 3,000, so 3,000, 6,000, and then next month's going to be 9,000, and then you could really have real savings rather than what the average American does, which is to have a savings account while having a comparable amount in credit cards that's at 20 to 30% interest. That's something you definitely don't want to do. But I've talked to people, I've talked to some of you on Zoom calls where you're telling me you got maybe 25 grand in savings and $30,000 in credit card debt. And to me, that's just kind of a wash because that savings account is just having money at 0.001% interest. All right, it's kind of growing, but you're having a comparable amount that's accruing interest at 30%. So, hey, you know, in my opinion, it's better just to get rid of that debt, right? But if you're in a position where you have that much savings, I think you're doing really well. Like I said, in my opinion, this is even the average American. I call this the average fake American because the average American would have something like this, right? And this would be zero. You see what I'm saying? But we're kind of going through our fake scenarios and fake math. And it's kind of like, what is it? Whose line is it anyway? Where the points don't matter and we're just kind of faking it or something like that. Anyways, so this is pretty much a newbie review of velocity banking. Again, it's two-step velocity banking basics. One, you got the budget, which you did right now. Paycheck, expenses, savings, expense breakdown. Number two, we got the line of credit, right? So just, you know, if you have no idea what a line of credit or you've only heard of credit cards, go ahead and look up lines of credit in Google. You know, look up the credit unions that are near where you live, and there should be banks or somewhere around you offering lines of credit if you're interested in getting them, right? And more banks are catching on to this velocity banking, so they're kind of promoting lines of credit because they know that people are very interested in this. Okay, well, so this is Korean Atlanta Mentorship. If you're interested in joining a group, go ahead and click the Google form link below, and we'll get on a one-on-one Zoom call to figure out, you know, if you're interested in joining the group. And if you're interested in emailing us, you can also email us by going to the About section of the YouTube channel. Have a great day, and we will speak next time.